Have you ever wondered what happens to the financial health of businesses when the economy takes a downturn? It is a crucial question for anyone looking to understand market dynamics and investment risks. During recessions, corporate credit risk generally increases significantly. This means that the likelihood of companies being unable to meet their debt obligations, such as making interest payments or repaying loans, becomes higher. The primary reason for this heightened risk is a widespread contraction in economic activity. When a recession hits, consumer spending often drops sharply, leading to reduced demand for products and services. Businesses experience lower revenues and thinner profit margins, making it challenging to generate enough cash flow to service their existing debts. Additionally, lenders, including banks and bond investors, become more risk-averse, tightening lending standards and making it harder for companies to refinance or secure new credit, especially for firms already under stress. This creates a difficult cycle where less revenue and restricted access to capital elevate the risk of default across various sectors. To navigate this, companies must proactively manage their balance sheets, focusing on maintaining strong liquidity and reducing their reliance on short-term debt. Investors, on the other hand, should conduct thorough due diligence, paying close attention to a company's debt-to-equity ratio, interest coverage ratio, and cash flow stability. Diversifying investments across sectors and companies with varying sensitivity to economic cycles can also help mitigate potential losses during these periods. A key indicator to watch during recessions is the widening of credit spreads. This refers to the difference in yield between corporate bonds and comparable government bonds, which are considered risk-free. As credit risk rises, investors demand higher compensation for holding corporate debt, causing credit spreads to widen. This widening is a direct reflection of the market's perception of increased default probability and a higher cost of borrowing for companies. Understanding how recessions impact corporate credit risk empowers you to make more informed investment and financial decisions. By recognizing the underlying mechanisms and key indicators, you can better anticipate potential challenges for businesses and position yourself to manage risk effectively, ultimately strengthening your overall financial knowledge and strategy.